This, you buy a stock for $10,000. A few years later, it's worth $25,000. You made profit of $15,000. But here is the question nobody asks first. How much of that profit do you actually keep? Because in America, the IRS taxes your gain, and depending on how you sell, you could pay almost double in tax. Today, I will break down what capital gains tax really is, short term versus long term, how much you actually pay, and legal strategies to reduce it. No confusion, just clarity. So, first, we discuss about what is capital gain tax. Capital gains tax is the tax you pay when you sell an asset for more than you bought it. Assets include stocks, real estate, crypto, businesses, ETFs, even collectibles. Important. You only pay tax when you sell, not when the value goes up. If your stock rose but you don't sell, no tax yet. That is called unrealized gain. But once you sell, now it's realized, now it's taxable. Now let's discuss short term versus long term. This is where the most people lose money. If you hold an asset for less than 1 year, short term capital gain. More than 1 year, long term capital gain. Short term gains are taxed as ordinary income. That's mean if you are in the 24% tax bracket, you pay 24% on that profit. Long term capital gains much lower depending on your income, like 0%, 15%, or 20%. Big difference, same asset, same profit, different timing, huge tax impact. Now let's discuss real example. Let's you make $80,000 salary, you sell stock for $20,000 profit. If short term, you might pay around 22 to 24%. That's roughly 4,400 plus in taxes. If long term, you may only pay 15%, that is $3,000 only. That is a $1,400 difference just for waiting. Now imagine profits of $100,000 or more. Timing becomes strategy. Now let's discuss real estate capital gains. Real estate has special advantages. If it's your primary residence, you can exclude $250,000 gain, $500,000 gain if you are married. As long as you live there 2 of the last 5 years, that's mean many homeowners pay zero capital gains tax when selling. Investors, they use something powerful, 1031 exchange. Sell one investment property, reinvest in to other, defer taxes. That is how real estate investors grow wealth without constantly paying tax. How we legally pay less tax. Here are smart strategies. Number one, hold assets for over 1 year. Long term rates are lower. Number two, tax loss harvesting. Sell losing investment to offset gain. If you don't know what is tax loss harvesting, go to my channel. There I uploaded complete detailed video on tax loss harvesting. If you made $20,000 profit and have $5,000 loss, you only pay tax on $15,000. Use retirement accounts. Both IRA grows tax free, 401k defers tax. Stay in lower income brackets. Sometimes spreading sales over multiple years reduces taxes rate. Set up in by species like estate planning strategy. Assets inherited are reset to current value. Huge wealth strategy for families. The biggest mistakes investor makes. They focus only on return, not after tax return. Making 12% but losing 30% to taxes is different than making 10% and keeping more. Smart investors don't just think how much did I make, they think how much do I keep. Taxes are not just an expense, they are a strategy. Capital gains tax is not something to fear, it is something to understand because once you understand timing, you control how much you pay. And the difference between average investors and wealthy investors isn't just what they earn, it is what they keep. Thank you for watching. If you like it, please like, subscribe, and comment what you want to know in the next video. Thank you.